Ever feel like your paycheck disappears the moment it hit your bank account? You are not alone in this. In South Africa, more and more people are resorting to credit to cover their basic expenses. Is this a sustainable solution, or are we digging ourselves into a bigger and deeper financial hole? In this video, we are going to go deeper and examine this growing dependency on credit and look at exactly how does it impact you as a household, as a business, as well as the impact on the economy as a whole. Hello, I'm Kenneth and welcome once again to Friday Money Matters this Friday and every Friday on this channel. If you're new here, please do consider subscription to the channel. Thank you so much for supporting the channel. This business tech article is the foundation for this video. However, we're going to go deeper and explore other things other than just those spoken about in this particular article. Basically, the concern is there is this growing dependency on credit. More and more households are depending on credit. So we have an increase in consumption and credit by the citizens, and therefore this has got massive implications on household incomes, on businesses, and the economy as a whole. And we're going to look at those impacts and the effects in this particular video. However, before we go deeper into the impact, let's try and focus and investigate a little bit on why is this happening? Why is there this increasing dependency on credit? The first reason is high inflation. Now, everything is increasing from food to fuel. And as a result, all the other things in between have been affected by higher and higher prices. You have seen it in the past few years or in the past economic seasons where prices have always been on the rise. Now, because of this, then you find household budgets unable to cover these inflationary increases. So as a result, households depend on credit to sort of supplement the income that they're getting. The second cause is stagnant wage growth. Now, as much as prices have increased, wages have sort of remained a little bit stagnant. Basically, the growth in wage increases is not a bit at par with the inflationary pressures that have been there on foodstuffs and all the other things that have been impacted by inflation. So as a result, there is a gap in the household budget because the wages are not keeping pace with the increases in the prices of basic necessities. So this all can only be covered from the point of household by debt. So debt becomes the temporary solution to make sure that household make it from month to month, thereby creating this trend that we are seeing in consumption credit. The next reason is the increasing availability of credit. The average consumer now has access to a lot of credit, from store cards to personal finances to credit cards. There is all this credit enticing the consumer. So when need arises, then the availability of credit and this easy access to credit makes it easy for people to get into debt. The fourth is the general cost of living. Cost of living has gone up. Back in the day, there used to be a lot of cost of living adjustments by a lot of employers, but this is not the current trend right now. You find that the consumer is left alone to find a way to adjust to the increases in the cost of living. So as a result, more and more people end up resorting to debt, thinking that they'll find relief there, hence creating this trend that we're seeing in household debt. All right, let us say that. Then we need to focus on the impact on household. In most cases, the impact is usually severe. One of the foremost and most important things to take note of is the debt cycle. Now, there is a debt cycle. The debt cycle is debt begets more debt. What that basically means is that at the end of the month or whatever period it is that the household gets income, because they are in debt, you'll find that more and more of their income has to go to service that particular debt. Now, once the income is gone to service the debt, it means that there is a gaping hole that is left where a lot of money now needs to be found elsewhere to cover the household budget. Now, because there is no other option or there is no other source, secondary or tertiary source of income, the household then resort to debt as a temporary relief. Now, it is meant to be temporary. However, it ends up becoming a cycle where after paying the debt, and then more debt is acquired for basic or day-to-day living. And this then means that at the end, when income comes, that income goes then to service that debt. So a cycle of ongoing debt after debt then ensues from there. The second one is financial stress. Now, in other cases, this has led to a lot of stress within the household unit, where you've seen a decrease in mental health and physical health, to other extents, where you find that the household unit cannot stand anymore. There are breakages in the household unit, leading to things such as divorce and so forth. So this comes from the financial stress that the household is facing as a result of debt. The next one is reduced disposable income. It's obvious that if a lot of money is going to service the debt, therefore it means that lesser and lesser money is being left as disposable income to cover the needs of the household. So this and then is not a situation where any household want to find themselves in. So this then becomes a contributing factor to the debt cycle, because the disposable income has been reduced. So the household has no option but to resort to more debt. Therefore, the trend grows and grows. The fourth one is the increased risk of default. Now, if there is more and more debt that the household is accruing, chances are that at a certain point, there is a chance that that particular household might default on that particular credit. So when that default happens, it means therefore that credit ratings decrease. Therefore, opportunities for debt in future, where probably now is necessary, maybe you want to get a mortgage or car loan or something like that, and then this becomes inaccessible because now there is a default, and that default might even lead to debt reviews in other cases. So the situation is quite hectic for a lot of households. Now, businesses also are being impacted by this increase in the trend of consumption credit. As a result, a lot of businesses are faced with the risk of bad debt. Now, bad debt is basically a liability to the business. Means that you have a lot of customers who have bought things on credit from you, or they have taken loans, or whatever the case might be. But these customers or consumers are your debtors. No. So these debtors then find themselves in a situation where they are unable to service their particular debt. So this is called bad debt. Now, bad debt is a liability for the business, and the impact is that this may lead to lesser and bad cash flows for the business, putting a business in such a place where the business does not have sufficient cash for operational purposes. So as a result, as you can see, businesses will be affected negatively, and moving forward, operations might go down, productivity and production units going down, and in other cases, even leading to closure. We saw a couple of years back the issue with African Bank, where a lot of its debtors were unable to service the debt. So as a result, it meant that they are put under a judicial management, and this obviously always leads to liquidation of such businesses. The second impact on businesses is reduced consumer spending. Obviously, because of large amounts of debts and a lot of their income going to service those particular debts, and then lesser and lesser money is left for the consumer to spend on other goods and services. So as a result, businesses find themselves in circumstances where they've got all this supply, all this inventory, and there is not sufficient enough demand to buy what they have produced. So you can see there, this results to lesser incomes for businesses, and with lesser incomes means that businesses need to find ways to reduce their costs. In other cases, this may lead to retrenchments and so forth. Other businesses have even resorted to relocating to other countries, to other areas, and so forth. Obviously, the reduction in consumer spending leads to the third impact for businesses, which is reduced sales. Now, sales are the main contributor to a business income. A business exists to make a profit. Therefore, a decrease in sales usually has got a direct impact on the profitability of that particular business. So you find businesses failing to meet their profit targets as a result of failing to get sufficient sales, because the majority of their customers find themselves in debt, and as a result, we say that their disposable income has decreased. Therefore, demand for the output for that particular business decreases, hence the reduction in sales. Now, the broader economic impacts in a lot of cases are very significant. One of the most well-known impacts of such a circumstance is a slower economic growth. Now, economic growth obviously has to be propelled by an economy that is producing more, but the increase in production can only exist if there is sufficient demand to buy whatever the businesses are producing. So in circumstances, as we have seen, businesses are faced with lesser demand for their output. What it basically means is that businesses are going to produce less. Now, a decrease in production obviously means that the total production or total output of that particular country, in this case South Africa, will decrease. So this decrease in production means a decrease in GDP, and therefore you find the economy going into a slump or slowing down. The second impact is increased economic vulnerability. Now, in most cases, where you find that the majority of people are heavily indebted, they find the economy becomes even more and more vulnerable to economic crises such as recessions, higher interest rates, and so forth. So this situation, if not arrested, then can give birth to other crises. Now, in this case, you find a situation such as a recession or even a depression in other cases. The third one is a strain on the financial system. Now, with a lot of people failing to service their debts, with a lot of bad debts and so forth, the financial system, the financial sector, as far as banks and so forth, find themselves under a lot of strain, because once money is gone out, it has to come back, and it is not coming back. And therefore, it means that much loss is being faced by those institutions, and as a result, we know that a lot of strain will be impacted on them, and this makes the situation even more dire. While some factors, such as higher interest rates, can be temporary and can be dealt with, other cases such as a runaway inflation and as well as stagnant wages can take longer to fix. Now, because of that, then a lot of attention need to be paid to this in order to arrest this trend in dependence on debt. What are your thoughts on this debt crisis? What are your experiences? What are sort of your suggestions? Please leave a comment down below and tell us exactly how you think this can be fixed, or how you are coping with it. If you're not coping, what other measures do you think must be put in place, either by the state or financial institutions or the households themselves, to make sure that they get themselves out of this debt? If you found this video interesting, please do give us a thumbs up. Also share with everyone else that you know, and also subscribe if you have not yet subscribed. Thank you so much for watching. This is Friday Money Matters. We'll see you in the next video. Bye.